Welcome to our 2024 webinar series. Throughout this series, we'll shine a light on three common client types that the only financial advisors often encounter. Follow the Green family as we illustrate the importance of lifetime insurance planning. So, who are the Greens? We have a married couple, Harry, a financial planner, and Lauren, a stay at home parent. A non married couple, Kevin, a cardiologist, and Irene, a dentist. No kids, but possibly in the future. And Sarah, a single female working as a software engineer. Each webinar will last about 50 minutes, so you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within 24 hours. Today we have two presenters. We start off with our critical illness specialist, Kathy Bilodeau, and end with Mark Maurer with life insurance. So take it away, Kathy.
Thank you. Good afternoon, and thank you all for joining us as we follow Harry and Lauren, Kevin and Devin, and finally Irene through all sorts of disability scenarios. Let's see, let's get to our slides here. So, what we're going to talk about first is covering group insurance for Harry's financial planning firm. And then we're going to look at some individual disability coverage for Harry because the group is not going to be sufficient. Then we're going to look at some critical illness for his wife, Lauren, in case something should happen to her. And then we're going to look at Kevin and Devin's cardiology practice. And finally, we're going to look at business overhead coverage for Irene's dental practice. So let's look at Harry and Lauren. Harry is a financial planner and he owns his own financial planning firm. And because more than 9 in 10 small businesses rank retaining key employees as their top business issue, we'll be looking at providing group benefits to his employees. And then we're also going to be looking at individual coverage for Harry because the group disability will not be sufficient to cover his $300,000 salary. And then lastly, we're going to be looking at critical illness for his wife, Lauren, because if something should happen to her, he's not going to be able to take time away from the firm to take care of her and the children. So when we talk about group insurance, what is it that we're trying to do for Harry? Excuse me, first and foremost, we want to provide some sort of group coverage to his employees to demonstrate how important they are to him and how important it is that they're protected. And it also shows how much he values them. So, in order to get group quotes insurance, these are the things I need first and foremost. I need to know the name of the business, the address of the business, and the nature of the business if it's not obvious by the name of the business. Now, with Harry's financial planning, I can probably deduce what he does for a living and what's the nature of the business. In addition to that, I will need a census completed. What the census is the name of the employees, their gender, their occupation, their income. Are they full time or part time? This will help me in order to prepare quotes. So, how many lives are needed? Just two. Obviously, anything less than two is not a group, it's an individual. What are the payment plan solutions? Well, it can be 100% employer paid, or it can be a combination of both employer and employee paid. What are the insurance solutions available? Well, we've got them all. We've got life, short and long term disability, vision, dental, accident, and critical illness. So the minimum required for 2 lives for life insurance and all the other insurance solutions. So when we're looking at life insurance, some of the things that we have to take into consideration is the underwriting. The less lives, the more underwriting. So with life insurance, we can go down to as little as 10,000 and as much as a $500,000. With short-term disability, this is a weekly benefit. So it can be paid as little as 40% up to 66%, anywhere between $250 to $2,500 a week. The normal individual, or excuse me, the normal niche is about 60% to $1,500 a week. The benefit period is usually 13 or 26 weeks, which is roughly 180 days or 90 days. And that's because it's made to segue into long term disability. The elimination period is 8, 15, or 30 days. It's supposed to be paid very soon, hence the reason short term. So you can choose one of those elimination periods. And then lastly, we're looking at group long term disability. Long term disability is paid on a monthly basis. And again, it can be as little as 40% up to 66%, and anywhere from $2,000 to $10,000 a month. The normal niche that we're doing is about 60% to $6,000 a month. And the benefit period can be as little as 2 years all the way up to age 65. The elimination period is, like I said, it's made to be segued from the short term, so it's 90 or 180 days. So when we're looking at groups, the younger the groups, usually the less the premium is because they're usually younger and healthier. Um, some of the rates that are for life, short-term and long-term disability is based upon the number of bodies going to be covered and what the ages of those bodies are. So let's see what's required from an underwriting standpoint. When we're looking at 2 to 4 lives, a lot of underwriting. So every single employee has to complete a medical questionnaire. And that's because there's not a lot of premium coming in. So the insurance company needs to know if there's any possible liability there. When we get to 5 to 9 lives, it's not an employee questionnaire, but rather it's an employer questionnaire. So the employer has to say if he knows of any employee that's been out 5 consecutive days in the last year, and if any employee or any of their dependents, if they're going to be covering the dependents under insurance, have had any serious medical condition. And you can see what some of them are: back, cancer, heart disease, etc. But when we get to 10 lives or more, it's guaranteed issue. So they don't ask any medical underwriting questions. And that's because there should be enough premium there for the insurance company to feel comfortable if any claims should come up. So when we purchase when we purchase life insurance on a group basis, there are some available assistance or programs available. And the first one is AXA Travel Assistance. And this is just if your employees are traveling and they lose their luggage or perhaps a watch or a camera or whatever the case may be, this will help them with that. In addition, if they're traveling and they have any kind of medical or dental emergency, they can assist with that. Also, if there's a language barrier because they're in a foreign country and they're having trouble communicating, they have access to this as well. And then lastly, if you're going to be, again, traveling to a foreign country, what are some things that you should know beforehand? Then we have the Will and Legal Document Center. Some of the things that offer here is, no kidding, a will with a Will and Legal Document Center. Then you have the healthcare and the durable power of attorney that can be made. You have your living will, any kind of medical treatment authorization. So if employees are going to be, leaving their children with someone and they want to make sure in case something happens, they have medical authorization to treat the minor children. And then lastly, estate planning tools and also an identity theft kit. And then lastly, if you've ever worked for a bigger company, you might be familiar with something called EAP, the Employee Assistance Program. The group benefits also offers that as well for people who might be having some sort of anxiety, substance abuse, some sort of addiction problem. They have access 24 hours a day, 7 days a week to a mental health professional that can assist them with those things. And then also discounts for laser vision and also a hearing aid program. So let's take a look at the benefits Harry wants to provide to his company. Because the nature of Harry's company is pretty much white collar, CFPs, paraplanners, and office staff, he doesn't have to have probably a lot of underwriting in that area. For him, he's interested in life and short term and long term disability, and he wants to pay for all of it. So it's not going to be contributory, it's all going to be paid for by him. So this is the typical group, what we're looking at. So for his group life insurance, he chose to do $50,000 each. Now, with 5 employees, he could have done obviously less than $50,000. He could have done one-time salary, but across the board, he chose to do $50,000 for each one of his employees, which also includes AD&D, and the monthly premium was $11. And then on an annual basis, it's under $134. And if the employees and the dependents do have the option to convert it, if it terminates. So let's look at short-term disability. Again, we're looking at the norm, which we usually quote is 60% to $1,500 a week. If he wanted more or less, he could have deviated from that. But it doesn't go higher than $2,500 a week. So he chose a benefit period of 12 weeks, which essentially is the segue for 90 days if someone still hasn't recovered from their disability from the short term and they move into long term disability, they will satisfy a 90-day elimination period. So the elimination period for the short term disability is 8 days injury and sickness. The monthly cost for this is less than $40. And on an annual basis, it's less than $480. So already he's looking like a great employer just by providing life and short term disability for such a small investment. And then lastly, the group long term disability. This is where we normally come in 60% to $6,000 a month, benefit period to age 65. And we did that 90-day elimination period because we did 12 weeks of benefits for the short term. And we did own occupation. And for those of you who don't know what that means, it simply means that if the client can't do the substantial material duties of their occupation and they choose to work in another occupation, they can collect 100% of the disability benefit plus 100% of their income from their new job. There is a mental substance abuse limitation of 24 months. So if someone is on claim for 24 months from a mental or substance abuse, and if they're not in a hospital setting, they will no longer collect disability benefits. This is pretty standard, both of these for group benefits. The monthly cost is about $125, and on an annual basis, that's $1,500. So between life insurance, short-term and long-term disability, he's putting in a total cost of about $2,100 a year for all three of those benefits. And that's really a good way to not only retain employees, but it's a good way for him to possibly invite new employees to join his firm. So now we're going to look at individual disability. And the reason for that is because we've done a great job for his planning firm, but what about Harry and his personal needs? Since small business owners rank individual disability income protection number 3 out of their top 10 priorities, it's important for us to make sure that we take a look at what his needs are in that area. Individual disability is a great standalone if you're just a regular W-2 employee, or in addition to group policy, which is what Harry's doing here. He's going to wrap it around his individual, or excuse me, he's going to wrap an individual around his group policy. Individual disability, even though Harry got to choose because he owns the policy or he owns the group with the group policy, he was able to pick and choose the benefit features and the percentages. When you do individual disability, you get to do the exact same thing. So as an individual, you can pick and choose the monthly benefit, the riders that you want, how long you want it to go for, and you can customize it to your liking, and it stays with you. So if an employee leaves Harry's financial planning, they don't get to take disability with them. With individual disability, it follows them wherever they go. So let's look at individual disability for Harry. So Harry is 45 years old. He's a financial planner, and at that occupation class, he's considered 5A. So that's one of the highest. The higher the occupation class, the lower the premium. So his income is approximately $300,000. His monthly benefit that he's eligible for minus the 60% to $6,000 of employer paid group, he's eligible for $12,545 a month. He chose a benefit period to age 65 and elimination period of 180 days with all our usual riders, COLA, ONOC, residual, catastrophic at 8,000, both the benefit update and the future benefit increase riders. These are riders that allow him to increase his monthly benefit as his income goes up in the future without any medical underwriting, just financial. And his monthly premium is approximately $450, and his annual premium is $5,400. I want to point out that men pay less for disability insurance than women do. And that's simply because women have a lot of pregnancy claims. And so when we get to Irene, who is our dentist, you're going to see she's paying a lot more for her disability. So just wanted to kind of point that out now. So Harry feels great that he's protected his employees in the event they should die prematurely or be stricken with an illness or injury. And he's also giving himself peace of mind that he's covered some more of his $300,000 income above and beyond the group coverage. But now it's time for him to take a look at what he can do for Lauren because he knows he wouldn't be able to take time off to take care of Lauren in the event something should happen to her. Um, so what we're going to do now is we're going to take a look at what we can do for Lauren, and we think critical illness might be the answer. So, critical illness may be a way to protect Lauren and Harry in the event something happens to her, because not only is it her he has to worry about, but because she stays home and takes care of the kids, we also have to worry about what happens to the children. Do we need to make sure there's a nanny? Do we need to make sure there's a tutor? Is there a need to be a housekeeper? So critical illness will avoid Harry from borrowing from his retirement fund, which I know all of you advisors would appreciate that, or even draining his financial planning business to pay his bills. Now, one of the things that we have to keep in mind is hopefully, most business owners have purchased an individual disability policy, so he'll have this available to him. And critical illness, what's great about it is it's not a one and done type policy, which you'll soon see. So some of you may or may not have heard of critical illness, so I'm just going to give you a little history lesson here on how it came to be. So back in the 80s, two heart surgeons created critical illness because they were doing heart transplants and they realized that after the surgery, even though the surgery went very well, their patients didn't thrive. And the reason for it is they were so financially under that they might have lost work from prior to the surgery, obviously recovering from the surgery, and obviously the medical bills from the surgery. So the two heart surgeons came up with the idea of what about some sort of insurance plan that would help them recover and help pay their bills in the event they had something like a heart transplant. Now, it has evolved from the 80s to now to cover more than just a heart transplant. It covers cancer, stroke, and several other conditions. And here are some of the other conditions it covers. In addition to heart attack, stroke, cancer, it also covers kidney failure, Alzheimer's, coma, paralysis. So it runs the gamut. I want to point out here where you see the 25% benefit. That just means that, let's say, in theory, someone has a $100,000 benefit and they've had bypass surgery. They're not going to get $100,000. They're only going to get 25,000. But in the event something more serious happens to them, let's say they have invasive cancer or they have a full blown heart attack, they will then get the remaining $75,000 of that benefit. So, some of the things to keep in mind with critical illness, and the reason I'm bringing this up is I just had a client who I quoted critical illness, and she came back today with a whole bunch of questions. And one of the questions was that she had talked to her health insurance company about her MOOP, which is her, I guess, her out of pocket, her major out of pocket. And she wanted to know how critical illness would play into this. And the great thing about critical illness, it pays in addition to any other health insurance, Medicare supplement, long term disability that a client may have. It can be purchased in addition to long term care or in lieu of it. It can help when you get the lump sum payment. It can help pay COBRA premiums. It can help pay a mortgage, medical bills, groceries, utilities. You can go on vacation. There is no dictation of where that money has to go. It can also pay for specialized care. So if someone has a medical condition that they need to travel out of town in order to get the treatment, critical illness can help with that. It can also help with the transportation and lodging while they make that travel out of the area in order to get that treatment. And it also prevents withdrawals from IRAs or 401ks, something you advisors would appreciate as well. And it replaces lost income from the working spouse. So in this case, if Harry was a W-2 employee and not an owner of the company, and he had to take time off and he wasn't being paid for it in order to take care of his wife and children, this critical illness could help offset the loss of his income. And it could also be used to provide income when someone's satisfying their elimination period during their long term disability or their long term care plan. So here's like the nuts and bolts of it. The issue ages with most carriers is between the ages of 18 and 70. The benefit can go from 10 years to lifetime. The benefit amounts can be as little as 5,000 to a half a million dollars. It's guaranteed renewable and non-cancelable. And for those of you who aren't familiar with that term, these terms, guaranteed renewable simply means that as long as you pay your premium, they can't terminate the policy. Non-cancelable means that they can't change the premium. So the premium is locked in at whatever the purchase price was when they took out the policy. Return of premium options are available, and additional critical illness riders are also available. And as I mentioned before, it pays more than once as long as there has been a 6 month separation between each diagnosis. And it covers an insured, a spouse, and children. So you can purchase one policy and cover more than one person. I've experimented with this, and what I have found is if you have the two parents be close in age, it's more economical to cover the female as the main insured and then use the rider to cover the husband and the children. So when we're looking at the benefit amount, the person who's purchasing the policy, the employed client, can purchase up to 6 times their earned income, and the benefit can be between $5,000 and a half a million dollars. When we're looking at the non-working spouse, so in this case, Lauren, because Harry makes $300,000, the maximum amount that she could get would be $150,000, 50% of the working spouse's income, up to a max of $250,000. So if the insured dies of any cause, not anything that's related to critical illness, their beneficiary receives all the premiums minus any benefits that were paid. So this is a really great feature. And then another one is if the insured dies of a covered illness, their beneficiary receives the maximum benefit minus any benefits previously paid. So it's not like your homeowner's insurance where you pay into it and you pay into it and you've never had a claim. You're not going to get anything back. At least with this, there's some nice features where you could obviously get some of that money back that's been paid in either through the benefit or through the premiums. So this isn't about Lauren. This is just an example of my not one and done. So let's just say we had a client who was 38 and at 38 suffered a heart attack and they had purchased a $200,000 benefit. They would get 200,000 because they had a full-blown heart attack. And at age 42, too bad, they had a stroke, lived through it, and they would still be eligible to collect $200,000. And at age 57, they suffered kidney failure, they'd be eligible for another $200,000. So between, those 20 years or 19 years, three things happened, they would have gotten a total benefit of $600,000. So here's our specific case, Lauren. She's 45, and again, we chose the 150,000, the maximum amount that she was eligible for. It's a lifetime, and her rider, we put additional critical accident rider on there. And in just a minute, it's going to pop up what that does. So what this does is it allows her, if she goes into the hospital, to receive $5,000 if she's in the hospital due to surgery for 1 to 2 days. If she's in the hospital 2 days and no surgery, she can get $7,500. And you can see on and on, she could get up to $25,000. Her monthly premium is $178, and on an annual basis, it's $2,000. So this is giving Harry peace of mind that in case something should happen to Lauren, he's got this plan in place to help offset if he has to hire, like I said, a tutor, a nanny, a housekeeper, whatever the case may be. Now we've done a good job of covering Harry and Lauren's household. Now let's see what we can do for Kevin and Irene. Kevin is a invasive cardiologist, and he shares a partnership with Devin. And Irene is a general dentist with her own successful practice. We're going to look at Kevin and Devin first because we need to look at disability buyout for both of them, and then we're going to look at business overhead for Irene's dental practice. So disability buyout provides a payment to the owner. So in this case, if Kevin was to be disabled, there has to be a mechanism for Devin to have the money available to buy out Kevin's share of the business and vice versa. So that's what disability buyout is. It's Mark's going to talk about life insurance buyout, but we're talking about disability buyout. And it's nice because the insurance policy is right there. Whereas if they tried to go to the bank and secure a loan to buy out and find out that one of the major partners is disabled, I don't know that the bank would look too highly on that to say, oh yeah, let's give you a loan so you can buy it out, your partner's shares. If Kevin and Devin were brothers, we probably could not get disability buyout insurance because in the eyes of the insurance company, they would just figure that as brothers, they would automatically give each other the other shares of the business. It helps to have a business valuation because without that, we can't determine the value of the business, so we don't know the amount of insurance. A buy sell agreement is what helps outline how the transfer of ownership is going to occur. When we're looking at buyout, it's usually good for 1 to 4 owners. The business usually has to have a value of $10 million or less. A buy sell agreement isn't necessary at the time of application, but it is at the time of claim for obvious reasons. How are we supposed to distribute this money? The minimum ownership between them has got to be 10%. We've had some financial planning firms that, were giving 5% out to various employees. That wasn't necessary to have a disability buyout in place because the ownership isn't at 10% yet. Some of the policy features of disability benefit are the maximum benefit is $3 million. We have a high elimination period, 365, a year, 2 years, 3 years. The reason for that is because you want that business owner to have an opportunity to recover from his disability and make his way back to the business. Benefits paid could be a lump sum, a monthly amount, or a combination for 24, 36, or 60 months. So let's look at Kevin. Kevin, like I said, is an invasive cardiologist. His occupation class is a 4 a.m. and he's 45 years old. And so what we're going to look at with him is an income of 400,000. He owns 50% of the business. The business was valued at approximately $3 million. And what they chose is a lump sum. So right out of the gate, there's going to be a lump sum of 1.25 million. And then the elimination period is 365 days. So after 365 days, 1.25 million will be available. But after that, for 2 years, there's going to also be a after 2 years, there'll be approximately $10,000, $420 also being paid. And we put the benefit update writer on this. This just says that in the event that the value of the business goes beyond the 3 million, that we have an opportunity to increase the 1.25 million and also that lump sum. So it's keeping up with the value of the business. The monthly premium for this is approximately $635, and on an annual basis, it's about $7,300. So when we're looking at Kevin, Kevin's going to be the exact same. His income is 400,000. The difference between Kevin is his age. He's approximately 2 years older than Kevin is. So Devin's premium is probably going to be slightly higher, but other than that, we're going to be looking at the exact same thing. We're going to be looking at him owning 50% of the practice. Practice is valued at 3 million. Lump sum benefit being paid at 1.25. Elimination period is going to be approximately 365 days. Monthly benefit, same thing, 10,420 will be paid after the lump sum of 1 year. So for 2 more years, $10,000 and 420 will be paid. And benefit update, So his premium is slightly higher, and that again, that's because he's 2 years older. His is just under $700, and his annual premium is just under 8,000. So Kevin's was 72.66. His is 79.36. So when we're looking at disability buyout options, we're going to be looking at all owners have to apply. The policy is owned by the company if entity purchased. So what that means is Kevin and Devin are the company representatives. So when Kevin is filling out his insurance application, Devin will sign as the company representative. When Devin is filling out his application, Kevin will sign as the company representative. They're the ones that enforce the buy sell agreement. The buy sell agreement is necessary at the time of claim, like I said, but not necessary at the time of application. There also has to be a detailed financial supplement completed at the time of application, and that's simply because we have to know the value of the business. We have to know kind of like what's been paid out, what are the expenses. Um, is it a legitimate business, not just laundering money here and there? So we've covered Kevin and his buyout disability with Devin for their cardiology practice. Now we're going to look at Irene, who, as I mentioned before, is a general dentist. She does have a friend who she told me would come in and run the practice in the event she becomes disabled. Now, something to remember when you bring someone in to run the practice, they will not get paid through the business overhead policy. In other words, whatever income that dentist earns is going to be his, and the business overhead is not going to pay him. If it's a W 2 employee like the dental hygienist, the office manager, that will come out of the business overhead, but not someone who's coming in to run the business. So let's go look at that in greater detail. So what is business overhead? It reimburses the business owner for any kind of expenses. So essentially, we want to keep the dental practice going so Irene has something to come back to. And if she purchases the policy, she can write it off as a business expense. So it'll be tax deductible. So this is an example on the left-hand side of what would be considered a covered expense. So as I mentioned before, employee benefits, rent, utilities, things that you traditionally wouldn't think would be covered, people traveling to a convention or moving expenses or entertainment. One to pay close attention to because she is a dentist, lab fees, medical supplies would not be covered as a business overhead expense. If you have someone who's interested in looking at a business overhead, let me know. I have a business overhead worksheet that I could email to you or to the client. They fill that out and it gives me an idea of what their total expenses are that they'd be spending so I know how to run the quote. So these are some of the particulars with regard to business overhead. It's designed for fee for service. Fee for service are organizations like law firms, CPAs, architects, engineering firms, good for 1 to 8 owners. When we're looking at other business owners, such as dentists in this particular occupation, physicians, optometrists, they want to keep it to 1 to 4 owners. What does it do? It provides a benefit to pay the monthly expenses to run the office, to run the practice, whatever it might be. And the maximum amount that it will pay is approximately $30,000 a month. And for obvious reasons, the loss of an owner would incur a significant loss of income to the business. So, what we're trying to do again is make sure there is a business for Irene to come back to. So let's look at Irene's case study. She is a general dentist. Her age is approximately 45, and she's earning $240,000. Her monthly benefit that she's eligible for is approximately $29,000. Her benefit period is 12 months, so she doesn't want to go so far, but she figures after 12 months, if she's not back to work, she's probably not going to make it back to work. So in this event, she wants to make sure that she's getting the money right away. So normally with business overhead, we have that smaller elimination period because we want to make sure that that money's coming in so we can pay the employees, pay her vendors, maintain her credit rating. We don't want anything to go, south or go, have a negative impact on her practice. And we put the residual and the benefit update riders. These allow her, in case she's working part-time, she can still use the monthly benefit. And in case her monthly benefit needs go up, her expenses, the benefit update will allow her to increase that 29,000 in the future. And her monthly premium, like I said, females pay more for disability, is $813, and her annual premium is approximately $9,300. So at least she's got this that she can write off as a tax deductible business expense. So, in summary, we covered Harry's financial planning, group insurance solutions for all of his employees. We also talked about how we could supplement Harry's individual disability, supplement Harry's group by giving him some individual disability for his $300,000 a year salary. We also put both Lauren and Harry's mind at ease because we've got some critical illness for Lauren in event something should happen to her. We put Kevin and Devin's mind at ease because now each of them has buyout insurance in case something should happen to them. And then lastly, we covered Irene and her dental practice. If something should happen to her, she has business overhead. She has a friend that will come in and run the practice. And this way, she'll have a practice to come back to. So right now I'm going to turn it over to Mark, who's going to talk about the life insurance side of business coverage. And at the end, we will answer all the questions for both sides of the presentation. Thank you for joining us.
All right, great. Kathy, thank you so much. And thank you everybody for tuning in. So I'm going to start talking about life insurance. And so there's a couple different things that we're going to talk about with life insurance when it comes to having a business own the policies, business type insurance. So there's key person and buyout or buy sell coverage. And both work, they're similar but different. So we're going to talk about some of the differences. So when we talk about key person life insurance, of course, the first person is who? Who do we want it to cover? Obviously, you're a key person. This may be a partner. This may be an owner, but it doesn't have to be. When we get to buy sell here in a couple minutes, that truly is buying out other owners' shares. But for key person, a lot of the time it's not the owner. It's somebody like an operations manager, a client relationship manager, creative financier, which is just a very nice word. Just it's fun to say. So these are people who, like I said, aren't necessarily the owners, but they're important to the ongoing business. So if that person was no longer around, there's a loss to the company. Those people may have special skills. They may be the rainmaker. They may be the #1 salesperson. They may be the #1 X, Y, or Z. But without that person there, there's a significant loss to the business, whether it's a loss of income, added expenses, a loss of knowledge. So we have that key person life insurance to protect the company from the financial loss of that key employee. So what can that life insurance, that influx of cash into the business do? Well, the business can use it to recruit, relocate, train, or replace talent. So if your #1 salesperson is gone, you know that Susie over at XYZ Plumbing, really, man, she can sell faucets like nobody else's business, and you just lost your #1 faucet sales guy. So you're calling Susie, hey Susie, you want to come over to my faucet sales business? So maybe there's money there that you're going to use to for a bonus, some kind of incentive to bring her over. Maybe you need to move Susie too. All right, there's some relocation money. Maybe you have people in-house that you can train. They need to go to school. They need to get certain requirements. You have good carpenters who you need to become contractors, and you're gonna say, I need to pay you guys to go to school. Otherwise, replacing all that talent. Replace lost profits. This one is probably now when you have your number one salesperson who is in charge of deals, and maybe deals are in process, but that person's no longer there, and everyone who's been working on this big M&A deal or whatever it might be says, oh, Claudia's no longer here. We don't want to work with anybody else but Claudia, so we have to rethink all this, and maybe that deal doesn't go through. So it helps replace those profits. Strengthen the balance sheet for creditors. If your number one faucet salesperson is gone, are you going to be able to, how is the business as strong as it was when Joe was here selling faucets? If you have an influx of cash into the business, then that strengthens the balance sheet and lets the business weather a short-term storm. So we've got the who and we've got the why. Who, key person. Why? Because the business has a financial loss if that person is deceased, no longer with the business. How much? Most insurance companies, 10 times annual compensation is going to be the maximum they could consider someone for. That's, somebody's making $100,000 with $1 million policy. You should be able to do pretty much anything you want with that to keep the business going, hire people, what have you. Most of the time when we're looking at policies for your clients or even your firms, I'm usually targeting 3 to 5 times. Again, just how much do you actually need and how much would work. Being able to get 3 times your key person makes $200,000 a year, getting $600,000 in cash, you probably can make a lot of things work. And that depends on their age, their retirement horizon, industry, location. A lot of that goes into it. If somebody's going to retire in a year, you definitely don't need 10 times their annual compensation. So some things are just kind of flow through naturally. But 3 to 5 times is about what we normally look at. Almost always term insurance. It's really a benefit to the business. The business is the owner. The business is a beneficiary. The term is to someone's retirement age. My business runs great. If Joe's here selling faucets, he's 45, normally going to retire at 65. By 65, if I'm still hanging all of my, all of my whole business on Joe, I know Joe's going to retire sometime. I need to buy, when Joe's 65, I need to have a contingency plan around, and maybe even one already up and going. So generally that's what we're looking at: term, estimated retirement age, business, owner, and beneficiary. And sometimes within this, there's a side agreement. It's not actually part of the insurance policy, business is owner and beneficiary, but there's another agreement from the business to the key employee that says, and if this happened, we as the business agree to pay your estate at one-time salary, or maybe the one-time salary, but over 2 or 3 years. Because the key person may look and say, wow, I'm such a key person that you need a $600,000 life insurance policy on me. Where does that go? Oh, to the business? And I have to go through the application and do all that? What do I get out of it? So generally, it's a good idea to add some sort of carrot or a cherry on top to say, okay, and if that happens, so we'll agree to some sort of side agreement. The important thing is that it's not paid from the life insurance policy. It's an agreement between the business and the key employee that the business will pay it out. So it's not actually paid through the life insurance, but the business would get the big life insurance and therefore can pay it out to the employee's estate or family. So let's look at Harry and with his key employee, Bo. So here's Bo, age 45. He's Harry's top rainmaker. What should they sell? I kind of like my faucets. They sell umbrellas. Get it? Rainmaker, umbrellas. Okay, so they make umbrellas. Bo, best umbrella salesman there is out there. Makes 100, wow. I think we should all go into the umbrella business. Bo makes $150,000 a year and $100,000 regular bonus. So his traditional regular income, $250,000. So insurance companies would likely consider up to $2.5 million in coverage. That's the upper bound for sure. Possible within their guidelines. That is many times a reasonable, allowable number. However, like I said, most of the time we might look at that and say, the business, do they really want, I don't know if Bo really wants a $2.5 million life insurance policy on him that Harry owns. I've seen murder she wrote where the life insurance coverage is a lot less than that, and all of a sudden somebody's brakes don't work. So 5 times income. The business should be able to do almost anything with $1.25 million, hiring Flo or Joe or whoever to come in and replace Bo. Bo's standard plus, so a 20-year term to age 65, $1.25 million a year, about $2,000 a year as a business expense, not a deductible, but just a normal operating expense to the business, that if Bo wasn't here tomorrow making it rain, everybody like that? Wow, I didn't know that even though everyone's on mute, I could actually hear you groan. I think it might just be a vibration in the force. That many people groaning at the exact same time. $2,000 a year for that coverage. That if Bo's the number one guy, $2,000 a year isn't all that much to make sure that the business is ongoing. Okay, key person. So that's one type. Now we have buyout or buy-sell agreement or buy-sell. Really shouldn't have said the word agreement here. It's really buy-sell. So there is an agreement. There is something contractual, either an operating agreement, a true buy-sell documents, that there's a legal contract that says if something happens to owner A, owner B must do blank at owner A's death, disability, what have you. So there's that legal document that is the buyout, that is the buy-sell, that's the agreement. But then there's how we fund it. So that buyout or buy-sell agreement guarantees business continuation in case if partner retires, dies, partner leaves, partner becomes disabled, or conflict between partners. That is the buyout agreement, the buy-sell agreement, the contract that specifies what's supposed to happen. Now, if partner dies, then the life insurance is the funding mechanism there. So let's look at Kevin and Devin. They each own 50% of the business, $3 million, worth $3 million. And by the way, just about 20%, 1 in 5 business owners have a buy-sell plan if one of the other owners were to die. So 1 out of 5 businesses may have an issue when the surviving owner wants to buy out the other person, because owner A's shares, absent agreement, are going to go to owner A's spouse, estate, kids. Owner B may really not want to be in business with owner A's spouse or kids. So if nothing else, just having a buy-sell agreement prevents that. Now then there's the funding mechanism, which is the life insurance. So Kevin is 45, Devin's 47. They each own a business. It's worth $3 million. Make it nice and easy, 50% ownership. So one solution, pretty simple. $1.5 million 20-year term policy on Kevin and Devin. So that when Kevin dies, there's $1.5 million that Devin can use to buy out Kevin's 50% ownership share. 2 designs, 2 ways to structure this. First one is cross purchase. Each owner owns a policy on every other owner. Each owner pays the premiums personally. And this works great if they're identical twins. Why do I say that? Because if they're identical twins, same age, let's go with even same health. I'm going to pay $1,000 a year for my twins policy. My twin's going to pay $1,000 a year for policy on me. We're evens. It's great if identical twins. I actually worked on helping some advisors with a buy-sell where 3 of the owners were all born the same year. Hardly ever happens. Usually, one owner has very little ownership and is young, and one owner has all the ownership and is older. So the young person is paying $4,000 a year for life insurance on the older person, and the older person may say the other person owns 10%. I can just buy her shares out, or is only paying $300 or $400 a year for a policy. So that's some of the issues with the cross-purchase design. But the advantages come when one owner dies and the survivorship sells. So that's the real reason we do this. And so let's look at Kevin and Devin in that scenario. Kevin owns a policy on Devin and is the beneficiary of this policy. Kevin and Devin is the owner and beneficiary of the policy on Kevin. Devin passes away. It sounds like a joke. Who's on first? Devin passes away. So Kevin gets the $1.5 million death benefit and purchases 50 shares. We're going to say there's 100 shares. 50 shares or 50% from Devin's estate for $1.5 million. There was the buy-sell agreement that there's a right of first refusal. Kevin got $1.5 million of life insurance, and he's going to use it to buy those shares. Kevin now has a basis of the $1.5 million in those shares he just bought, but he only has a $100,000 basis in his original 50 shares, right? So in 5 years, Kevin sells to somebody else, Joe. Joe got out of the faucet business and now he's buying firms. So in 5 years, Kevin sells all 100 shares for $3 million. He has a basis of $1.6 million, so he's going to owe tax on 1.4. Like I said, this really is kind of only a thing if one partner dies and when the surviving partner sells. Do we get this big step up in basis on the deceased partner shares? Cross purchase is fantastic for 2 people. It's even better for identical twins, but great for 2 people because one person owns a policy on each other, and that's it. Now, what happens if we have 3 people? Kevin needs to own a policy on Devin and Eric. Eric needs to own a policy on Kevin and Devin. Devin needs to own a policy on Kevin and Eric. So now we have 6 policies. The math for how many policies we have is the number of owners times the number of owners minus 1. So in this scenario, 3 owners times 3 minus 1 is 2, 6 owners. If we have 4 owners, we need 12 policies because each owner must own a policy on the other 3. If we have 5 owners, 20 policies. So all of a sudden, this really starts to get complicated. It's just too much. Nobody wants to be chasing around 20 different life insurance policies. At the best, people have a hard time keeping track of their 1 or 2, let alone 20. So our disadvantages can be complexity when we have number of policies, lots of owners. So each owner is going to maintain those policies personally or may not. That might be a problem too. If one partner is unhealthy, they pay more. It might be a little too personal for each owner to own the policy on each other. Or we have design number 2. The business is the owner and beneficiary of 1 policy per owner. The main advantages here are fewer policies to maintain and the business is responsible for maintenance. Now, in the tax scenario where one partner dies and then they sell, what happens is Devin passes away again. The business gets a life insurance for $1.5 million. and the business retires those 50 shares. So Devon's estate gets a step up in basis at death upon selling back to the business, no capital gains, income tax. So Devon's estate is pretty much square either way. The value of the business is 1.5 at death. That's the value, got 1.5, no tax. Now Kevin now only has a basis of $100,000, right? That's what we had before. But now there's only 50 outstanding shares. He didn't buy those shares. The business retired those shares. So now Kevin has his basis, original basis of $100,000, owns 100% of the business, which is only 50 shares. So in 5 years, when Kevin sells the business for $3 million, his basis is only the original $100,000. So like I said, it's still the most common. The entity purchase, it's called stock redemption sometimes too, when there's more than 2 owners, because our day-to-day simplicity wins out to try to worry too much about that scenario where what happens when one owner dies and then trying to sell the business later. So Kathy talked about a number of disability things. I talked about key person and life insurance for a buyout. See what questions anybody might have in just a second, but just to touch base, we'll be at all these conferences here in the next, wow, that's just next month is August, so August and October. So as you're out going to conferences, make sure you come by and talk to the LLIS people. Claudia, do you have any questions? All right. No questions? Fantastic. Kathy, you and I did such a good job. There's no questions. All right. We have, so just real quick, and we have a couple more webinars coming up. Jerry will be talking about annuities next month, and then we'll be talking a few other things about life insurance, hybrids, long-term care, and yeah, Kathy, anything that I said you want to talk about? We got 3 minutes.
No, just that I hope that everybody understands the concept of the need for both life insurance and disability insurance, regardless if they have it at work. Because a lot of times people think, oh, I have that at work, I don't need it, and they don't really realize what they have at work. You know, if it's $100,000 of life insurance, that may not be sufficient. If you're only getting $3,000 or $4,000 a month of disability, and you're making $300,000 or even $175,000, that's just not going to be sufficient. So we encourage all the advisors to make sure that they look at the actual plans that they have and see if we can't provide some additional coverage to them.
All right, great. And Claudia, still no other questions? She says nothing. She's great. She's all chatty at the beginning, but now she's got nothing. All right. Well, thank you everybody for tuning in. I hope everybody's summer is going well. Looks like here in Tampa it's just about to start our regular afternoon thunderstorms. So I hope everybody has a great rest of your summer, good start to the school year. And I hope everybody just, like I said, thank you for tuning in to everybody.
All right. Join us next month. See ya.
All right. Thanks, everybody. Bye.